going to be a flat to slightly upside open. Let's bring in our guest, Tim Pagliara, Chief Investment Officer at CapWealth Advisors. Tim, great of you to join us today. I can imagine Jay Powell with his tightrope. He's between two big skyscrapers and he's trying to just keep that balance. Is it very important that he doesn't say anything this Friday that is going to upset that apple cart that is very, very much priced for a September start to an easing cycle?
Yeah, I think you're exactly correct. The impetus right now is for a rate cut, and the futures market is banking on it to the point where if we didn't get a rate cut for some reason, it would be very disruptive to the financial market. So I think it's almost assured at this point that we will get at least 0.25% cut.
Is there any argument to not cut, though? I mean, all things being equal, take out expectations and worries about dislocations in the market. Is there actually an argument to not go ahead with that cut in September, Tim?
Absolutely. You know, inflation is still running hot. Even though it's come down, it's still in the 3 to 3.5% range by the most recent data. And when you look at the bond investor, for example, in the 10-year Treasury, how much lower can a 10-year Treasury go when you're bumping up against the inflation rate before taxes or anything else? So while the Fed has control, I believe, over bringing short-term rates down, you're still going to have those longer-term yields stubborn, and I think potentially they could even rise over the next 3 to 6 months, depending upon how the inflation numbers continue to come in.
Tim, it's Sam here. Very good morning, good evening, your time. We saw the rebound rally hitting the pause button overnight, snapping that 8-day winning streak, as we've been highlighting. Do you forecast that we could be in for some more sort of so-called digestion issues, not just with Jackson Hole, but with some of the earnings and what we're likely to hear from Harris at the end of the week?
Well, I think digestion, it's more like indigestion, because the economic proposals that are coming out of the Harris camp, focusing on price controls, and today, a 44.6% capital gains rate, a 25% tax on unrealized gains. The market's not going to be very receptive to that because, first, the price controls don't work, and people have been, dissecting that since Friday, and now they have these new tax proposals, including a 28% cap or 28% corporate tax rate. So all of that leads to a lot of disruption, a lot of thought about how you respond in the event of a Harris win. So there's a lot to digest over the next few days.
So what's your outlook for the market then, Tim? Because, if the markets are of the thinking that we buy the rumor, sell the news, if the Fed is very much going to confirm the plan this week, and then we do see that sort of 25 basis point cut, as a lot of the market has been pricing in September, do we see a case of then those who've been really driving this sort of rally and the gains that we've seen since August the 5th, when we had that complete meltdown, start to book profits, and then the broader market gets FOMO and starts to do the same thing?
Well, I'll actually be at a luncheon and have an opportunity to ask a question of Chairman Powell mid to the end of September. And the question that I'll ask him, and the question that I don't think is asked enough, is what would our level of economic activity be if we were not spending 7 to 8% annual GDP deficits? Economists tell you that anything over 3% should not occur unless we're in a time of a financial crisis or a war. And so this uncontrolled spending in Washington, D.C., while it does stimulate the economy, it is unsustainable long term, and it has to be addressed.
Yeah, and we've been speaking to a number of guests who very much highlighted that this perhaps is the risk for some of those investors as we look at that broad set of policies that Harris has announced, for instance, and what that might be highlighting about some of those deficit concerns. But Tim, we're going to continue this conversation. Sit tight. Tim Pagliara of CapWealth Advisors does stay with us, and we'll be back to talk about some individual movers on Wall Street when we come back. Do stay with us here on Street Signs. We're back with Tim Pagliara, who is the Chief Investment Officer at CapWealth Advisors. Thanks for staying with us, Tim. I do want to pick up on something that you've highlighted in your notes, and something that I've been tracking really closely is energy. And, you know, utilities have also been a defensive trade, reliable dividends. They have been a safe haven trade to sort of shelter from the recent volatility. But there's a big question as to whether this is now part of the AI trade, given that, you know, all these AI data centers need power. So is this something that you're seeing in terms of whether we can actually pull on that thread as to whether this can become an AI trade?
Oh, absolutely. I believe that, you know, if you look at the picks and shovels approach to AI, there are a lot of industries that are going to benefit. The electric utility industry is one. Natural gas industry will definitely benefit because increasing electricity power grid, the fastest way to do it is through natural gas turbines, though a lot of companies will benefit from that, primarily the natural gas producers and pipeline concerns. So there's a lot of ways of making money in the AI trade other than just owning NVIDIA.
Yeah, I want to pick up on that because you have certainly suggested, or at least highlighted in your notes, the concentration risk. And, you know, a lot of our guests have been highlighting that. We had one on last week that was suggesting that investors in, you know, Mag 7 have actually been playing a dangerous game of musical chairs, because we all remember our childhood when you're left on the floor and only one person is left on the seat. Is that the sort of risk that you're talking about? And, you know, how can we sort of broaden out this trade? You mentioned, of course, utilities and energy.
Well, another good example of this would be something that's just evolved over the last month and a half with Microsoft. When they reported earnings, you know, everybody was a little shocked by the increase in their CapEx number. And yet, you know, at the same time, they entered into an agreement with Lumen to provide connectivity between data centers. And at the same time, Lumen entered into an agreement with Corning to buy 10% of all their fiber that they could produce over the next 2 years. So the play there is it takes 10 times as much fiber to connect an AI chip. It takes 10 times as much electricity. And data center infrastructure is not just the data center, it's the connectivity between these data centers. So I've explained it in a real simple way. You know, we used to have 4K TVs, and they'd say, well, don't buy them because broadband won't support them yet. Well, that's one of the problems with AI. One of the opportunities is that you have to increase the connectivity, the speed. That's all fiber. Lumen is uniquely positioned. Kate Johnson's done a tremendous job of turning that company around and getting them focused on real growth opportunities going forward.
AI not as green as originally thought. Let's turn our attention to private credit. Is there stress brewing in the private credit space? And I ask this because I'm increasingly hearing about small and medium-sized businesses who go to the bank, they want a loan to be able to expand or even just survive, pay the rent and pay the labor costs, and they're not getting access to capital. So they have no choice but to go to private credit, sometimes at an average cost of about 9.5%. Is this an area where there might be some stress cracks opening up?
Well, 9.5% or higher. You know, we're seeing some at 12 to 15%. I think one of the big problems potentially with private credit is that Wall Street, through private equity, they create these vehicles where investors don't have to see the price on a daily basis. So they price these things off of a grid. And as private equity rolls out, and you have to start pricing some of this private credit, there's a lot of shock potentially in the market because of vacancies, the perception that there's going to be problems in the commercial real estate space. So I believe that going into the first and second quarter of next year, we're going to see some real stress finally in the commercial real estate space as these existing private credit transactions have to be unwound through the liquidation process.
And it sure is that shoe that we've been waiting to drop. And I guess when it does drop eventually, it could be a really big thud, really big shoe. Thank you so much for joining us today, Tim Pagliara, joining us there from Tennessee, Franklin, Tennessee. Okay.